Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals. FX options are a low-risk alternative to hedging currency moves in any market condition.
And that's what I'm paying for the in-the-money option. But remember, the one disadvantage of buying the in-the-money option, if I'm really, really wrong, I have more nominal dollars at risk. So what does it all mean? The difference between the strike price and the asset price creates the ultimate value at expiration. The intrinsic value of an option is the value of the option if it were to be exercised immediately. At expiration, all options are going to be worth their intrinsic value or the big zero. Prior to, that's what we're trading. We're trading prior to expiration. What's the likelihood of an asset moving, an exchange rate moving from X to Y or X to Z, whatever the strike price is? At expiration, all options are going to have that 0 or 100 delta. They're not going to be trading of a 64 delta or 50. At expiration, they're either going to settle into cash, some value, or they're going to be worth 0. Another thing I'm going to talk about in the future when I give the presentation on Greeks is gamma. Gamma tells me how quickly my delta is changing, and theta measures how great the cost is per day. I know it's a lot that I'm throwing out at you today, and please come back for the future webinars where I talk more about these various terms and what they really mean, what they mean for all of us, investors, traders, people that are we're thinking we're considering the FX options market. What's the dollar? I think it's going to go up. I think it's going to go down. Well, that's why you want to learn more about the delta and the gamma and the theta and the vega. These are important things to learn. How is the cost determined? Based on these pricing models, and I'm going to get to that future webinar. The models are just based on probabilities, the likelihood of it moving to different prices. Obviously, the in-the-money options are going to have higher prices and higher deltas, and the models actually spit out those values and deltas. These values can help you decide which strike price you want to trade. Once you understand the risk-reward of the trade, then you can make an appropriate decision. I'm going to spend a whole hour on this in the future on options pricing, and that webinar will be on February 11th. But suffice to say that option models help us understand more about the market. We look at strike price, the exchange rate of the asset price, time left, the interest rate, dividend, although we're not talking about dividends. If we're looking at exchange rates, we're looking at the interest rate differential between one currency to another and the volatility of the asset. Volatility, we're going to be talking about volatility in the future. And we have a lot of guests to talk about that. Jason Ayers will be talking about adjusting option strategies to the volatility of the marketplace. That webinar is going to be conducted on February 9th, and I'll be talking about volatility also in the future. Lots of different ways that you can learn about this, so continue to come back to the ISC for all your FX options educational needs. Volatility is really important when you're looking at the options pricing. The more volatile the underlier, generally the higher the option premium. The Greek term vega measures this option sensitivity to changes in implied volatility. And the vols, or volatilities, are dynamic. They change each day, and they must be considered prior to entering any options transaction. So if I look at it, and today we're trading at, let's say, 106. The at-the-money calls or puts, that might be my first choice. But then I might want to look at in-the-money calls. Again, if I'm looking for less leverage and I think the asset's going to move slightly, I might want to look at in-the-money calls because I think the asset will continue to go higher. That would be one choice. Or the at-the-money calls or the out-of-the-money calls. How do I decide? It's really based on how much leverage I want to have. If I think it's going to make the asset's going to make a big, big move, I might want to buy the out-of-the-money calls. If I think it's going to be a moderate move, I might buy the at-the-money calls. If I'm thinking it's going to be just a slight move, I might buy in-the-money calls. If I'm bearish, I just turn it all around and say, again, it's about leverage. If I want the most leverage, I'm looking at out-of-the-money puts because they give me a lot of leverage. They don't cost much in nominal terms. Followed by the at-the-money puts. And then the in-the-money puts are going to move most like the exchange rate in reverse, if you will. So if I think that the U.S. dollar Canadian is going to drop just, a little bit, but I'm pretty certain that I want to make that forecast, I might want to buy a U.S. dollar Canadian dollar put. If I think it might make a bigger move, I might want to buy, U.S. dollar Canadian dollar in the money put. If I thought it might make a bigger move, I might buy an at the money put. And if I thought that the U.S. dollar, the greenback, might really take a beating, I would look at the out of the money puts. Word of caution, lots of option models out there. They don't guarantee success no matter how much you learn because a lot of people know about these models. In fact, I love this quote from a gentleman, George Pellenbach. He once said that all models are wrong, but some are useful. You never, ever, ever want to risk more than you're willing to lose in any one trade. And again, markets can move in an inexplicable fashion from time to time. When you're looking at the options market, essentially I can turn this distribution, and that's what these option prices are really made of, these normal or log normal distributions, and we're making a forecast on how much the asset will move over a certain period of time. Bigger moves, again, if I thought it was going to make a huge move, I might want to buy an out-of-the-money put. That might make sense. If I thought it was going to make a big move to the upside, I might buy an out-of-the-money call. Be an out-of-the-money put. Moderate moves, at the money or even in the monies. But it's all dependent on how much volatility you see in the marketplace in the future. We have not seen a lot of volatility in the FX market over the last 6 months or even maybe 4 months, definitely. Even in the last couple weeks where the equity market has gotten more and more volatile, the FX market has really not followed suit. When we talk of cost of money in equities, we're looking at interest rates and dividends, but when we're talking cost of money in currency options, we're talking interest rate differential from one currency to another. So at the IC, we're now trading the Brazilian real. The Brazilian real interest rate is much higher than the U.S., so the interest rate differential is much higher there. Where if I'm looking at U.S. dollar Canadian, the interest rate differential might not be much at all. Of course, that might change in the future. So leverage, what is it? Well, in physics, it's a factor by which lever multiplies a force. In finance, it's defined as using given resources in such a way that potential positive or negative outcome is magnified. So hence the phrase, leverage is a double-edged sword. If I knew the market was going to make a big move, I would simply buy out-of-the-money call options or out-of-the-money put options. Problem is that if the market makes a moderate move, I might be buying out-of-the-money call options or out-of-the-money put options, be right on the market, and still lose my entire investment. So I need to think in terms of not only which direction, timing, but magnitude. But again, if I want to, and again, some FX traders like leverage, some don't, but if you like leverage, you're probably going to gravitate towards the out-of-the-money options. If you don't like leverage, you might want to look at the in-the-money options or sometimes the at-the-money options.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.